Hi, my name is Choi, and I'm the founder of Money Geek. And welcome to the third episode of the short course on investments. And today we're going to talk about stocks. And very simply put, stocks are piece ownerships of companies. And that's why when you own a share, you're considered a shareholder. That is someone who shares in the profits of that company. Anyone can buy and sell stocks very easily. All you need is something called a brokerage account, which we'll talk more about later on in this course. And stocks are very liquid investments, which means that unless you're trying to trade millions of dollars worth of stocks, you should be able to very cheaply and quickly buy and sell stocks, usually within seconds. There are some 15,000 stocks listed in the US and some 6,000 stocks listed in Canada. So here's a question. You know, some people say that stocks as a whole did well in some years, and the same people say that stocks as a whole did badly in some other years. But like I said, there are 6,000 stocks in Canada alone. And you know, in any given year, some stocks will do better than other stocks. So for example, TD might have done well one year, but in the same year, Rogers might have done poorly. So how can these people say that stocks as a whole did well in any given year? The answer is that when people say that the stock market went up, what they really mean is that a particular stock market index went up. So you can think of a stock market index as a basket of stocks. So for example, the TSX 60 contains the 60 biggest companies traded on the Toronto Stock Exchange. The S&P 500 contains the 500 biggest companies traded in the US. And the Dow Jones Index, which is the oldest and the most popular one quoted by the media, contains the 30 biggest and most historic companies traded in the US. And if you look at the long-term records of these stock market indices, you'll see that stocks have been great investments. For example, the Dow Jones Index, which as we mentioned is the oldest index around, has returned about 9% per year for the past 100 years. And this came with a moderately high risk of around 15% standard deviation. And this means that on a great year, the Dow Jones returned as much as 35%, or even higher in some special years. But on the downside, on a very poor year, it would have a loss of 20%, or even a bigger loss in some special years. But if you look at it over the long run, the trend is very clear. The Dow Jones Index moved up over time. Now the S&P 500 has a more limited history, but it seems to display similar statistics to the Dow Jones. And interestingly enough, the TSS indices seems to have similar statistics to the US indices as well, which means that Canadian stocks have performed about as well as US stocks did over a long period of time. And the same actually went for a lot of the Western worlds, so countries like Britain, France, and so forth. So why have stocks returned 9% per year? Well, as John Bogle, who is the founder of Vanguard, puts it, if you invested $1 into an American or a Canadian corporation, that corporation would have repaid you at a rate of 9% per year. And that repayment could have come in the form of dividends, stock buybacks, and so forth. But over the long run, no matter what method, the average shareholder would have received 9% per year on their investment. And here's a big question. Will this 9% per year continue into the future? And I personally think so, and for reasons that Warren Buffett explains. You see, Warren Buffett says that we in the Western world didn't do well because we're any smarter, better looking, or better fit, or what have you. But we did better because there's a system in place that draws out human potential. So a capitalist system and the rule of law that prevails in our countries. Over the past 100 years, the Western world has gone through 2 world wars, a Great Depression, oil shocks, real estate bubbles, and anything in between. Yet over the long run, stocks have still returned 9% per year. And that's because the basic system is still in place. And as Warren Buffett explains, as long as the system is still in place, he's optimistic about the future, and quite frankly, so am I. Now, up until now, I kept the discussion of our stocks to stock market indices, and that's for a reason. And the reason is that I really want to discourage people from stock picking. Not because I think it's impossible to pick stocks, after all, I do it myself, but because I think it's really difficult to do it right. Research shows that people in general are overconfident. And that means that everybody thinks that they are above average. Yet common sense tells us that only half of us can be above average. But in this game of stock picking, you can't just be above average. You gotta be, very substantially above average to make it worth your while. And research, for this reason, research shows that most people who try to pick stocks end up underperforming the market. And also, I find that a lot of people who pick stocks end up just not being diversified enough, so that when one or two bad news hits their stocks, it ends up wiping out their whole portfolio. So while picking stocks can be done, it usually takes a lot more research and a lot more work than people think it does. And it also requires a lot of discipline and a lot of experience to pull it off successfully. So for most people, I don't recommend it. Instead, I recommend that people hold a basket of stocks. And in later episodes of this course, I'll explain just how to do that very effectively. And that's what I had to say about stocks. So let's recap what we have learned today. We learned that stocks are part ownerships of corporations. And we learned that we use stock market indices, which are baskets of stocks, to gauge the overall movement of the stock market. We learned that stocks have returned 9% per year, at least here in the Western world. And it also came with a standard deviation of 15%, which is moderately high. We also learned that stocks are very liquid investments, which means that you can buy and sell them very easily and very cheaply and very quickly. And finally, I ended with a cautionary note against picking individual stocks. That's all I have for today, and I hope you're enjoying this course so far. And if you are, please consider sharing this video using the share buttons below. In the next episode, I'll talk about bonds and GICs. So thank you very much for watching, and have a great day.